always had this in our model, in our projections and our valuation, that they would buy out the remainder of Barstool. And the price was already, pretty much, we had that baked in already. So it's there, and now they control 100% of it. And now it can be a little bit more geared, I think, to their liking and what, suits Penn the best. But look, I think Barstool, generally speaking, is been given zero credit now. Maybe initially it did when the stock was at 140. We didn't like it back then, but it was pretty clear that Barstool was a big part of that valuation. So now you've got really two angles here. One is the sports betting side, and then you've got the media side. And again, the media side just has not been valued appropriately. I mean, we've gone through the valuation analysis many different ways, including looking at other, podcasts, what they've sold for, what other media companies are going for. And it's pretty clear that, Penn's core business is, fairly in line with where the stock's trading at right now. So very little in the way of sports betting and iGaming, and then, zero, maybe even less in terms of Barstool. So we've always thought Barstool fits really, really nice in their omnichannel, in Penn's omnichannel strategy. The good news now, you're starting to see a little bit better sentiment. We've been on the wrong side of Penn, over the past, 6-9 months, but we've been on the right side of DraftKings in the overall sports betting industry. What we missed was, anticipating how much the negativity surrounding sports betting would flow into Penn. But the good news is the sentiment seems to be improving a little bit. Now we're heading into football season, and last year, that's when we really got negative on DraftKings, because we thought marketing spend and promotional spend would be much higher than people thought heading into that football season. So it's an easy comp from that perspective, which means it should be a positive if these guys can control themselves. And the less marketing spend there is, the better it is for Penn and Barstool, because Penn and Barstool decided that they were not going to go crazy with external marketing spend, and that hurt their market share, which also hurt their stock price and overall sentiment and the multiple. But necessarily, it means that if marketing spend comes down, and it will eventually come down, I don't know if it's going to come down for football season, hopefully so. If it comes down, that means necessarily that Penn's market share goes up, and that'll be an additional catalyst. So Penn's starting to benefit a little bit from what we're seeing in terms of overall sentiment. But then I think when the market share numbers come out, and Penn does over-index to football too, so that should help as well. I think you're going to see improving sentiment. So, just from an institutional focus, we are getting more incoming calls on Penn. I think, nobody wanted to touch it until things started to stabilize on the sports betting side. And ultimately that seems like it's the right strategy, but you're starting to see Penn act better too. And I think that's a reflection of improving sentiment.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there, subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.